morning, everybody, and thank you so much for joining us for another one of our webinars. This time is on investment themes, and you're all here because you got an invitation from us, and the heading of which was, Is the World at War? And our response to it. And the world is at war. How do we define that? Is it Russia-Ukraine? We don't think so. That's adding to the current volatility. We are living in very uncertain times. And when times are uncertain, markets do not react well. But we think there's more to it than that. And there are huge global economic shifts which are causing disconnects, which lead to the uncertainty and volatility we are experiencing at this time. We need to give you some context on this. We've been here before in the last 40 years, and we will, I hate to say it, at some point we'll go here again. But at the moment, the losses we've been seeing and the dips that we're seeing in the markets are very concerning, and that's what we wanted to run through with you. But in terms of have we been here before, to name but a few, in 1987, there was Black Monday, otherwise known as a flash crash. There was a collapse of 20% in one day. In 1998, we had the Russian ruble collapse. All of these things caused markets to fall. 2000, we had the dot-com bubble. I'm sure you all remember 9/11 and the Twin Towers. I'm sure you more than remember the great financial crisis in 2007, 2008, and what that did to your investments. And then in 2020, we had the pandemic, which was a quick down and then a rally back. And now here we are again in 2022, and the markets are really very difficult. And we think it's not only, as I mentioned, there are other global economic shifts. We've got US interest rates that are rising. We've got inflation that's become a problem. Anyway, I am now going to hand over to our experts on the topics. And that is Mike Gresti, our Chief Investment Officer, and Ross McConaughey, who looks after the offshore side of our business and the shares that we are invested in. They watch this very, very closely every day, and they're going to talk to you about what is going on and our response to it. Thank you so much for joining us, and I hand over to Mike.
Good morning, everybody, and thank you very much for the introduction, Di. Let's get right on into it. Right, so over the next 35 minutes or so, Ross and I are going to take you on a little bit of a tour through, our thoughts on a lot of the issues that are particularly top of mind at the moment. And, I'm going to do that from a sort of more top-down macro perspective. And then Ross is going to get into the real brass tacks of what do our portfolios look like, what are we doing, what are we thinking about in terms of the actual shares themselves that comprise the portfolio. And as we run through this, perhaps the one message that I want you to think very carefully about, because I know emotions are running high. I read this morning that the S&P's fall year to date is the second biggest decline in history. So we've certainly got off, as Di said, to a very difficult start to the year. But we are where we are today, and the important message is don't be caught fighting yesterday's war. So I really want, as we run through a couple of slides on the various issues that are sort of top of mind for investors at the moment, to keep thinking about that message. Now, if we step back to the beginning of the year, what was the sort of market outlook for the year that we charted at that point? And just bear in mind that, essentially the way we think about markets is that, markets are incredibly good discounting machines. So the outcome that we get in the short term, in the last couple of months for sure, is really the consequence of how events are unfolding differently to how they were predicted by the market. And there's no doubt that as things have unfolded so far this year, there's no doubt that they have been a lot more negative than the picture as we saw it at the beginning of the year. But just to reflect back on how things appeared at that point, we saw investors facing a bit of a dilemma as we entered 2022. On the more negative side, we knew that the economic life support that had been in place through COVID was being withdrawn, interest rates were likely to rise, and the showering of cash, quantitative easing, was going to go into reverse. Inflation was problematic, and we certainly saw that likely to continue through the first half of 2022. And finally, equity market valuations were still pretty elevated. However, the flip side of that was that economic growth expectations were actually quite strong as we came out of COVID. And I like to sort of liken it, so to speak, to a dimmer switch being turned back on as economies gradually opened up. And that sort of charted the outlook for a pretty good economic outlook. And it's very seldom that if economies are growing, that equities are not rising. Then, 2022 kicked off. And frankly, the two big events that have happened, no surprises there. You'll see them on the slide there. Russia invaded Ukraine. The timing, frankly, seems hardly a coincidence, because frankly, that probably hit us right in the area of most acute concern for investors and intensified it, as did China doubling down on its zero COVID policies, really acutely impacting us from an inflation perspective. And we're seeing that start to come through. And if there's one thing that has probably been the big change in expectations since the beginning of the year, it's been expectations around how high inflation would go. Anyway, what I'm going to do now is just take you through a couple of perspectives on each of these things and try and give you a little bit of balance to probably what you're seeing in the press, which is a lot of very negative and concerning comments. Just looking firstly at global inflation. What we're showing on this slide here is UBS's forecast, but frankly, there are very similar sort of profiles of inflation coming through from most of the brokers that we follow. And essentially, there are two lines on this chart. The one being kind of all-in CPI, the brown line. It includes obviously everything. And then core CPI is the one which certainly policy setters focus on more, which is taking out a lot of those very volatile items. And it's really the core CPI that they look at particularly closely when it comes to setting interest rates. Now, for some time, you can see that big spike up in inflation, and we're really at what I would call potentially peak pain in terms of inflation. And you can see how the profile going forward, we're expecting to see that roll over quite sharply in the back end of this year. That was always the profile we were expecting. No doubt, though, the peak that we're seeing at the moment has been a lot higher than had been expected at the beginning of the year. But just to reflect briefly on the nature of inflation. So yes, it feels particularly painful at the moment. We are certainly reading lots of negative and alarming views being put out there. But the important thing about inflation, frankly, is that prices have to continue to rise on top of what are already pretty big increases that we've seen for that inflation number to remain high. And, if you reflect back into the second half of 2021, we're already seeing quite high levels of inflation, and you can see it there on the chart, in fact. So as we enter, the back end of 2022, we're already coming up against what we call quite high base effects. The inflation number that we've seen just announced was a little bit of a negative surprise, and the markets have once again have reacted quite negatively to that. So there's no doubt that this is probably the peak area of concern among investors at the moment. But it's a question of what does this profile look like into the second half of this year and beyond. And you can really see how the heat is expected to come out of this particular issue. And then the next thing to consider is, what does inflation typically do to shares? And we've gone back through history and essentially looked at periods when inflation has exceeded 5%. There have been a number of those. And importantly, not only looked at what it's meant for equity markets, but importantly looked at what it's meant for quality shares, which, we're going to get into a little bit more detail about the type of shares that we like to invest in. But we certainly tend to gravitate towards that type of share. And hence we've looked specifically at, how quality shares have done during periods of high inflation. And what I've done is I've color-coded this. So, the green ones are the ones, and I hope none of you are colorblind out there, because I know that green and red is a big no-no in terms of slides for people who struggle with colors. But essentially the green ones there are the periods in which quality shares, the types of shares we like to invest in, have outperformed. And the red ones, by the same token, are the period that, whether it's the broader market or quality shares that have underperformed. And in a way, no surprises. Throughout most periods of higher inflation, quality shares have outperformed. And, why I say no surprises is, naturally, those are the kind of shares that have a much stronger competitive moat. They're much more able to pass on inflationary increases to consumers. And we would expect them to weather inflation pretty well. The other thing that I note is through an entire inflation cycle, for the most part, in these periods, equities have delivered positive returns. It's been a very different feel this time round, but it'll be important to look back by the end of this inflation cycle to conclude, how did this impact markets? And it's always worth keeping in mind that companies are essentially they live in a nominal world. So when inflation rises, they are businesses that are able to pass that through, and you would expect to see earnings growth from companies by and large rising in a higher inflation environment. The next issue to focus on is the current double down, I guess you could call it, of China on COVID. And I must say this is a very difficult issue at the moment, mainly because it seems that China has decided to take COVID as a real ideological battle and has spent much of the last 2 years berating the decadent West for its more, can I call it, laissez-faire approach to COVID, and the eventual recognition by the West that COVID is something we're going to have to learn to live with, whereas China have decided that they want to pursue this zero COVID policy. And we really are in the eye of the storm a little bit as far as that's concerned. So what this chart is showing you is, over various periods in the last few years, what is happening to subway passenger traffic across the 10 major cities in China. And you can see how in 2020, which was the real eye of the storm, when COVID initially hit, it dropped to almost zero. You can see each year that spike down, which is the drop in traffic around Chinese New Year. And then very recently, you can see the impact that we're having in 2022 as a result of the lockdowns that are currently underway in China. Now, we are starting to see some early news suggesting that infection rates are beginning to moderate. But there's no doubt this is an area that is causing particular frustration around supply chains and certainly economic growth expectations in China. Now, our thinking on this is it may persist for a while, and certainly it seems as if ahead of the China elective conference at the back end of this year, where Xi Jinping is seeking a third term, there's likely to be a holdout because he needs to save face. But honestly, this looks to us like a sort of, if I can call it, a 1 PE multiple event. It's a highly improbable that China is going to persist indefinitely with this degree of lockdown. And you're already starting to see quite severe public pushback on the restrictions that are being imposed on them. So we are probably living through the very worst of this in terms of the impact that it's likely to have longer term on China, and by the same token, the rest of the world from a supply chain and a growth perspective. Now, turning to the issue of supply chain, what we're showing here is a picture over time of, if I can call it, the relative tightness or slackness of the global supply chain. So where you see those green areas, it implies that supply chains are relatively loose, and no surprises, the red spikes up indicate periods of extreme tightness in global supply chains, taking particularly long periods of time to get goods from the East to US markets, for example. And you can see how during those periods of great tightness, inflation has spiked up. And at the moment, there's a very good relationship between what you can see there as very tight inflation, very tight supply chains, and the massive spike up in inflation. Now, importantly, if you look at the most recent data there are already signs that this is beginning to roll over. Other things we could have shown include what's happened to ships lined up at US ports. That has already started to decline quite sharply. The US trucking problem that was a major concern at the back end of last year has largely disappeared. Of course, The offset to that, as we just showed on the previous slide, is that we are facing these Chinese lockdowns, which have added another area of concern from a supply chain perspective. But broadly, we think we are past the worst on this. And importantly, to reflect back on that point we made earlier on about not fighting yesterday's war. It has certainly been an acute concern up to now, but it's very important to consider what is the direction of travel from here. And as potentially we see these supply chain issues addressed, it certainly is likely to take the heat out of inflation. And that's exactly the picture you're seeing from those inflation forecasts we showed earlier on. Now, turning to the next issue, which is obviously the Ukraine-Russia war, which really caught us by surprise in February of this year. Now, the best way we can approach this is once again to look back at history and say, how much does a particular geopolitical event ultimately impact markets? So lots of numbers. I apologize for that, but it certainly gives you a good perspective. I think the first thing to look at is the column on the extreme right-hand side, which shows what we call the maximum drawdown past an event. So that's essentially the most by which markets fell subsequent to a particular geopolitical event. And what you can see there is that almost, I think it's pretty much 100% certainty there that after a geopolitical event, there is a jolt to market sentiment and there is a bit of a pullback of varying degrees. But then if you look at the other columns, you generally see as time passes after the initial event, you've seen an increasing normalization in markets. And certainly by the time we're a year out of those particular events, markets are kind of very much back to normal for the most part. The other thing that kind of stands out for me from this particular set of data is that really it's almost, if I can say, not the event itself that determines where markets go, but really what kind of market environment that we're already in when that particular event occurs. So if we're in a significant bear market and we have a geopolitical event, no surprises, we seem to have a more protracted period of negative impact, where if it's a bull market, a temporary setback, and we're back into positive territory. The Ukraine-Russia invasion, obviously it's very early days with that. It's had quite a negative impact so far. And I think possibly because we're already in quite a nervous environment, as I sort of explained the situation we faced at the beginning of the year. And in this particular situation, the invasion, I question whether it was actually as accidental from a timing perspective, since it seems to have really hit us in the area we were most concerned about, which was inflation. And obviously with the disruption from a commodity perspective, that's really amplified concerns around inflation. But, we think as the year progresses, supply chains adjust. What is likely to happen is that oil flows and commodity flows will readjust to accommodate the sanctions that are in place right now. And the world will begin to come to terms with the implications longer term of Russia being increasingly isolated. And it's important to keep in mind that Russia, from an economy size perspective, is probably about the size of Spain. So yes, painful, but certainly not something that for the very long term is likely to upset global growth. So again, it's an area of problem at the moment, but one which the world is likely to increasingly come to terms with and adjust for as the year progresses. Just looking at economic growth, what I've shown here is first of all world economic growth and then developed markets. And why I've shown the two is that I think there's a fair amount of concern about the quality of data that goes into particularly emerging market economic growth. So what's probably most important in terms of what's going to drive markets going forward is really developed market economic growth. And there's no doubt that sort of US sets the trend in terms of how the world will react to the risk of recession. So we have seen growth numbers coming back, no doubt about that. But you can see that at this stage, we're certainly not projecting, or certainly collectively economists are not projecting a recession. I have to admit, they're very poor at projecting a recession and tend to sort of drift downwards into that event. So it's far from inconceivable that that's maybe where we end up. And the probability of a recession has risen. But, the reality is we're still in a situation where the Fed in particular has the ability to dial back what are already quite bearish expectations around how high interest rates are likely to go in the event that we see growth beginning to falter. So as I say, at the moment, we're certainly not seeing by any means a global recession as our base case. Admittedly, risks around that have risen somewhat since the beginning of the year, given what's happened around inflation and the disruptions we've seen. And then just a further perspective on what's happened to valuation. So I made the point at the beginning of the presentation that one of the more negative concerns we had was that we went into 2022 with valuations, and I've just shown here the S&P 500, the US market, because it's a pretty good sort of benchmark for how the world is seeing equity valuations. We went into the year with valuations at a relatively elevated rate. So what are we showing here from a valuation perspective? It's the price of shares or the index as a multiple of expected earnings. And the higher that is, so the higher the chart there, or the white line you see on the chart, the higher the valuation of the overall market. And you can see how at the beginning of 2022, valuations were still quite high. They had come back somewhat from the extremes that they had reached, but relative to a longer term history, it's very hard to argue that we were in cheap territory. And what I've done on this particular chart is overlaid it with what has happened to the 10-year US government bond yield, the essential sort of benchmark for global risk-free rates, if you like. And one of the things that investors have been fretting about for a long time now is what would happen as interest rates began to rise, because the relative attractiveness of equities in a higher interest rate environment becomes less and less. And there was a concern that valuations would come back down as a result of rising US interest rates. And you can see how we reached pretty much an all-time low in late 2020 from a long bond perspective, very close to zero. And we've seen US bond yields rising steadily to a point where at the moment they're at around 3%. And that as a consequence, you've seen those valuations, that valuation pulling back very sharply on global equities. Now, the important point to note here is that at current levels, we are now back at a point where we're not too dissimilar to where US equities have been trading, for the better part of the last 6, 7, 8 years. So that overvaluation that existed over the last, let's say, 18 months has almost entirely disappeared. And the other thing that I see is that when we look back, let's say a decade or so, the US markets were very comfortably able to maintain a multiple of between 15 and 20 times, despite the fact that US bond yields were in the region of 6% or so. So yes, it seems to have been a very painful sentiment transition that has happened as rates have risen. But now we're at a point where that inflated valuation has largely disappeared. So again, I just remind you, be very careful of fighting yesterday's war. Sentiment is very negative at the moment, but that overvaluation that may have existed with the benefit of hindsight has largely disappeared as a result of this dramatic pullback we've seen already in US markets. Now, just before I hand over to Ross, I wanted to just remind you of the type of shares that we invest in and why we invest in those shares. So, we've always talked about our preference for quality shares, which we define as companies generating high returns on their capital. And not only do they generate high returns on their capital, but they have the ability to reinvest that capital and those returns they're generating in further growth opportunities. And it's that power of compounding over the long term that we are looking for. Essentially, it's Einstein's eighth wonder of the world, the power of compounding. And the way I've tried to illustrate this is to show a couple of examples of shares that you would expect to see in your offshore portfolio, the ones in green in each of these charts. I hope those names are familiar to you. And then compared their performance over the last decade or so with a selection of other shares that would typically fall outside of our natural hitting zone from an investment perspective. And for those, I've selected, quite carefully some different themes. So I've picked an industrial smokestack company on the left-hand side there. Ford obviously makes motor vehicles. I've picked Newmont as a big gold producer, the biggest in the world. Obviously, gold being quite topical in this particular period of risk off. And then Vestas, which is a big name in the green energy transition world. They make wind turbines, and obviously being quite a topical area as we talk about the transition to green energy. And then what these charts show you is how these shares have performed over the last decade, as I mentioned. And you can see how the ones in green, these high ROCE compounders, have absolutely trounced these, call them lower return businesses, even though in some cases they've benefited from time to time from particular investor appeal because of themes that are playing out. So the point being made here is ultimately it's returns that prevail, and the ability to generate returns on capital, and not so much a short theme stock, if I can call it that. On the right-hand side there, I've shown things slightly differently, and I've looked at companies that generate high returns but actually pay out most of that in dividends because they don't have the ability to reinvest that money into growth opportunities within their sector. Now, there's nothing wrong with paying dividends, that's for sure. But what we just wanted to highlight is it's that lack of ability to compound their growth that, frankly, over time has begun to count against them from a total return perspective. And there you can see another selection of shares that I hope you would be familiar with looking at your portfolios, falling into the category of high return compounders that are continuing to win out. So that really sort of gives you an introduction and a good segue into what Ross is going to talk about now when we really delve into what are we doing in our portfolios and why are we investing in the type of shares we do. So thank you very much. I'm going to hand over to Ross.
Great. I'm going to discuss a little bit what's going on in the markets at the moment. This is quite a busy graph, but we'll run through it nice and slowly. So this is all these sectors in the S&P 500 sorted by their pullback from their recent highs. So from left to right, you have those shares that have pulled back very little, and on the right are the shares that have pulled back drastically. Now, on the green block on the left-hand side, it's the S&P 500 and the MSCI World. When we did these calcs towards the end of April, MSCI and world markets were down. S&P 500 MSCI World were down about 15%. So looking from left to right, food products were down about 5%, tobacco down 5%, beverages, multi-utilities, electric utilities, insurance, all have held up very nicely in the current environment. If you go to the other side of the markets, you can look at internet and direct marketing. That's where Amazon is. And eBay, that's been off about 40% from its all-time highs. So at RCI, we typically invest in those sectors that are circled. Those are your places where your high-quality compounders and high return on capital businesses tend to be. And at the moment, they've been drastically under pressure of late. So we've also sort of ranked the two sides to the market at the moment. So the mostly growth and the mostly value. And it's quite obvious from this graph that you can see there's been a big pullback in the growth and quality shares and a lot of movement and flows into the mostly value shares. And we're going to take a look into a little bit deeper as to what's actually happening on a long-term basis in these sectors and whether it's good to be in value or growth over the long run. What's important to note that at this point in time, 50% of the stock market has fallen over 20%. So even though the market is only down 15%, there's actually been an enormous amount of pain underneath the surface. So let's delve a little bit deeper into these sectors. So here we go. Here we have a table where we've ranked all these sectors by their 1-year performance. So oil and gas is up 60% over the year. Energy, equipment and services up 60%. Metals and mining up 38%. So it's been a fantastic year for these sectors. On the other side, the shares that have done really poorly, down 30% for the year. Internet direct marketing, again, that's where Amazon is and Etsy and eBay, interactive media services, and all had a really tough year. And again, the blue highlighted sectors are those where RCI tend to look for shares. Now, what's important to understand here, that even though oil and gas has done 60% for the last year, if you take a look at it over the 5-year period, that's the right-hand column, they've actually only done about 35% over the last 5 years. So when you look at the market, which did about 50%, you can see this has been a severe underperformance on a long-term basis. So even though something like tobacco, which has had a hell of a year in the last, going up 12%, which is far better than the S&P 500's zero, over the long term, you would have been down 15%. Again, now if we talked about the sectors that we tend to invest in, things like IT services, which is Visa and MasterCard, they've had a poor year, but over 5 years, up 80%. Technology, hardware, and service up 94%, better than the stock market. Places like software, that's where you see your Microsoft and Adobe software. That's had a 200% increase over the last 5 years. So it's important to realize that even though sectors may have their time in the sun over the short term, it's really you've got to make sure you're in the correct sectors for the long term. So what kind of shares do we look for? So we typically look for high quality compounders, just as Mike spoke about earlier. Now, in our universe, we have about 85 shares that we look at very closely, and we've put a whole bunch of them on the screen here. You'll notice many of these shares: Home Depot, Disney, Apple, MasterCard, things like Netflix, Unilever, LVMH, Domino's Pizza, McDonald's, all well-known household brand names. If you take a collective of this universe of shares, these high-quality compounders, their year-to-date performance has been down 18%, far worse than the S&P 500 and far worse than the MSCI World. Over the 1 year, they're down about 8%, again, worse than the markets. What's really been scary is how much they've fallen from their recent highs. On average, these quality shares have fallen 30% from their recent highs, far worse than the S&P 500, which has fallen 11%. But again, if you look at over the 5-year period, if you had held an equal share of all these companies, you would have had 155% upside in your portfolio versus the market's 50 to 80%. So again, it's really important to have quality compounders for long-term performance. So what does it actually mean to be a quality portfolio? What are we actually looking for? So the first thing we're looking at is superior earnings growth to that of the market. So if you take a look at our current offshore portfolios, and we've weighted average the different shares that are in our portfolios, we could actually calculate the EPS of the portfolio going backwards and forwards in time. So for our portfolio at the moment, the growth rate over the last 5 years has been about 25% in the EPS. That's more than double the market. And what's even more important in the expectations of the next 3 years, our portfolio is going to grow earnings per share by 19%. Again, far better than the S&P 500 and the global markets in general. So what else do we look for when we're picking high quality businesses? So one of the other things we really like to focus on is return on capital, return on equity. We've got to make sure that these businesses are performing very well relative to the market. So again, here, looking at our portfolio, the weighted average has been about 27% ROE, which is again much better than the S&P 500, and the higher the better here. And our return on invested capital, 19%, again, much better than global markets. And another important metric is to make sure that our businesses have got a good balance sheet, a strong balance sheet, and the debt to equity level is much lower than the market. And that's very important, because you want to have a portfolio of shares that doesn't have too much debt, especially if there's any sort of a recessionary environment or any in a rising interest rate environment. So we know that our portfolios are very well suited for that future. Another metric to look at is the gross profit margin, which is the absolute simple, most basic metric you can measure on a portfolio. And our portfolio, on average, has a return of 46% gross profit margin, again, which is much better than market. So, we're pretty happy with our portfolio, and we really do believe that it's a strong and effective portfolio for long-term performance. But when you buy quality, it tends to come at a premium valuation to the rest of the market, and you would expect that. So what we've gone and done is calculated the PE ratio of our portfolio going back in time over the last 6 years. That's the blue line on the top part of the graph. And the two lines below, the orange and gray, is the valuation of the S&P 500 and the MSCI World. And what's important to take from this is our portfolio is always traded at a premium valuation to the market. But what we can actually measure here is how much that premium has changed over time. So what we can do is subtract the blue line from the gray line from the blue line and get the difference between the two, and that is your premium over time. So let's take a look at that. So if we graph that premium, we can clearly see when the portfolio was relatively cheap versus the market, like in 2018, 2019, or relatively expensive versus the market. So that's above 13 and below 10 is where the kind of band is. Now, you could see then clearly, with hindsight, that our portfolios of high quality shares were relatively expensive during the COVID crisis. And they were a bit overpriced at that point in time. But what's really important, what happened of late, in the last few months, there's been a dramatic sell-off in quality shares. You can see there's never been a point in time in the last 6 years that our portfolio of quality shares has been as attractively priced versus the market. At this point in time, you really do not want to capitulate on quality. That's really fundamental positioning for the long-term performance. So with that, I'm going to hand it back to Mike. Thank you very much.
Great, Ross. Thank you very much. I hope that's given you a little bit of a sense of perspective on, what's going on under the bonnet in our portfolios. And there's no doubt that we're at the point where, if I can sort of use the car analogy, you're paying a relatively discounted price for a BMW, in terms of buying those quality shares. And, that's essentially what we're seeking to do. We're not selling Forksies here. So now we are almost at the end now. But, I just wanted to, again, give you a little bit of perspective on drawdowns and hopefully give you some reassurance of the fact that the sun does come up. So now what we've done here is we've looked at the last 3 major drawdowns that we've seen in the last 20 years or so. And I'm sure that these are going to be points in your investment history that you will remember very clearly, because they've all come with their degrees of pain and fear. And the 3 that we're looking at are, first of all, the dot-com bust that happened in the very early 2000s, and then the global financial crisis, which happened around 2008, 2009. And then, as Di mentioned at the beginning, the very sharp, severe correction that took place in the beginning of the COVID pandemic. And a couple of points that I would observe here is that, maybe one has to acknowledge that each of these have been associated with very different issues that drove them. But it's pretty clear there that, if you just look at the shape of those circles, over time, these drawdowns seem to have become much shorter and sharper. So you can see that dot-com bubble burst, if you like, that actually took a couple of years to unfold, whereas certainly if we look at the most recent one, the COVID-related collapse was literally over in a couple of months. Now, looking at the most recent drawdown, certainly as Ross highlighted, the quality growth shares have been in a stealth bear market for, pretty much the last 18 months. I think at an index level, we started to feel this perhaps towards the back end of last year, but we're already 6 months into this now. And you can really see on the chart the sort of degree of pullback, and we've spoken to that already in some detail. So, I think it's important to understand just how far into this pullback we already are. Now, just taking a look at the tables at the bottom, just to give you some reassurance here, what we wanted to look at is kind of the nightmare scenario. What would happen if you were that extremely unfortunate investor that got sucked in at the very top of the market, as we called it, the worst market timer? So literally invested all of your money at the very day that the market peaked before it went into a bear market where markets fell more than 20% subsequently. And essentially what we then looked at is what would have happened to you in terms of your returns if you had had the fortitude to hold all the way through that downturn. Admittedly, it would have been extremely difficult to do that, but simply kept your eyes on the horizon and then ridden that downturn all the way through and then benefited from the subsequent recovery. And you can see that in each of those cases, the compound return that you got in US dollars subsequently has very comfortably beaten inflation. And if you consider as a Rand investor that over time, and I'm really looking over the last 20 years or so, you probably got 5% in annual Rand devaluation on top of that. The reality is, even in the worst of those returns, the dot-com crash subsequently, in Rand terms, you've got a very, very healthy, comfortably inflation-beating return. But the important message was that it's important to just hold the line through these events that, as Di mentioned initially, we've seen them before, we will get through it. Obviously the nightmare scenario, frankly, and what typically tends to happen with investors is that as you tend to find yourself losing heart at what turns out to be very close to the bottom, throw the towel in, close the door on equities, and then don't look at them until suddenly you start to hear all those around you making very positive comments around the returns that they're making, just as we're starting to get back towards the top of markets once again. And that's the sort of disaster scenario that many investors find themselves bailing at the bottom and then getting sucked in near the top, an absolute nightmare scenario. Of course, what we would all love to be is what we call the best market timer. And we've shown those returns on the right-hand side there. And of course, it goes without saying that if you were able to do that and get it absolutely right, of course, you're going to make much better returns. But it's a rare investor that has the willpower to make those extremely contrarian calls at the absolute bottom of the market. And the key message really is, stay invested, keep your eyes on the horizon, and, that we will ultimately get through this. And it really remains the asset class that over the long term provides you with the highest probability of giving you that inflation-beating return that you're looking for. Just as we head towards the conclusion here, that's all well and good to say these things, and I think many of us sort of intuitively understand them, but we are where we are, and what are we at RCI actually doing about it? So just a couple of points here. The first thing, and this is not something that specifically happens during market corrections, part of what we do is to ensure that clients do have an adequate cash buffer to enable them to go through periods of market challenge without the need to necessarily sell equities at depressed valuations. And it's at times like this that we'll be calling on those cash balances. It doesn't feel great, admittedly, but that's what they're there for. And it enables us to ride through these periods of volatility without necessarily having to crystallize losses. Something that we're being particularly focused on in this drawdown, and I must say it's something that I guess in the past, if we look at ourselves in terms of mistakes that we've made, is that we've tended to be a little bit flat-footed and get a little bit like bunnies in the headlights during major corrections. And, what tends to happen is that all shares get sold off. So the, relative fundamentals of the companies really go out the window in a panic. And what's great about that is it creates opportunities to get into shares that historically we've missed, but suddenly are on sale. And there's a tremendous number of those that we're beginning to identify now. And what we are really aiming to do is to make sure across all of your portfolios, we come out of this downturn with the best possible portfolio of good quality compound growers that we can. There's a saying that it's not what you own going into a downturn, it's what you own coming out of it that really matters. And, what we hope to do is to diversify the industries in which we're invested. We've possibly been up to this point quite highly concentrated in technology shares, for example, and due to high valuations, missed the opportunity to invest in high ROCE compounders in, the food space, medical devices, for example, luxury goods. And we're really looking now at some wonderful opportunities to add those to your portfolio. So expect to see potentially some new names beginning to appear. And then, obviously there are those situations, of course, where investors, for one reason or another, are really unable to take the risk of further drawdowns from here. And in the short term, frankly, where markets are going to go is highly sentiment driven. And in those instances, we're going to be looking at introducing various insured products, guaranteed products. These do come at a cost, so they're not for everybody. What typically happens is that they either limit you from a liquidity perspective going forward, or like all things with insurance, at times of greatest risk, these products tend to cost the most. So they do come at a cost, but where appropriate, we'll be looking to introduce those. Our focus remains, however, on ensuring absolute quality in the portfolio. Ross made it very clear we're not deviating from that. It has been a difficult time for quality. No doubt it did get relatively expensive in the 2 years sort of preceding 2022. But as Ross said, it was pretty clear that we've now got BMWs on sale, and we're not going to miss the opportunity to benefit from that on your behalf. So really, that's, I hope, the message that has come across clearly to you. Don't be caught fighting yesterday's war. Journalists get paid to make things appear as scary as possible to ensure that you remain glued. Perhaps it's important to reflect on the fact that the world typically doesn't usually end to turn out being nearly as exciting or fear-mongering as what these journalists would have you believe. And we certainly are of the view that ultimately, as we get through this into the second half of the year, hopefully we will see things turn out in a much more mundane fashion than the extreme views you're currently seeing at the moment. I've just shown there our various contact details. We're always here, very happy to discuss all of this further with you should you want to chat through any of this in further detail. I really thank you on behalf of the rest of the team that have presented today for your time. I hope it's been useful. Please send through any questions that you may have, and we are always here to engage with you on any concerns or issues that this may have sparked for you. Thank you once again for your time, and goodbye.